Hello and welcome to today's episode of On the Mark Financial Literacy with Mark Zinman. We have Alicia here with us today. Hello, Alicia.
Hi.
Hello. And we have Mark with us today. Hello, Mark.
Hello, Monica and Alicia. How are you doing today?
All right, so we were just chit-chatting a little bit, and we kind of digressed a little bit off of today's topics.
But I want to, before you get to today's topic, one of the things we were chit-chatting about was, how long people were listening to and what kind of, that maybe financial literacy is not the most sexy of topics. Mm-hmm. So I have something to say that hopefully in the beginning will keep viewers in. Anyone who hasn't heard, Travis and Taylor got engaged. I know this might be old news, but I'm going to make the announcement on the Mark podcast. So they got 20 million views for that. I'll take maybe a couple thousand, okay, extra. So please sign up for our podcast now that we've made that great announcement.
So today we're talking about something perhaps a little bit less, what would the word be, Mark? A little bit less.
Well, we're talking about credit scores, and I believe that Taylor and Travis have good credit scores. We can talk.
We can safely make that assumption. Today we're talking. Jason, maybe. So today we're talking about credit scores, and then we're going to segue into auto financing and buy versus lease, right? Okay, so as we start today's podcast, we want to talk about, let's identify who the national credit score agencies are, the credit bureaus, being Equifax, Experian, and TransUnion. And then we have two different types of ranges. We have FICO scores and Vantage scores, yes? Yeah. And we have some ranges for each, exceptional for a FICO score ranging 800 to 850, and excellent for a Vantage score being 781 to 850. So why don't we talk a little bit here about what makes up one's credit score?
Right, because this is probably one of the most often non-accounting questions I get is activities that people may do and how it's going to affect their credit score. And it's usually worried about it being negative as opposed to a positive thing. So the first thing to maybe talk about is like what makes up your credit score, right? 35% of the credit score is based on your payment history. So that is the highest number, and so the timeliness of payments and stuff like that is the most effective. Credit utilization. And I looked at my credit score today, and it said how long and length of time is 15% of your credit score, and credit utilization is 30%. So right on there, I went on my Discover card, and they have like your free credit score, and you can find this maybe a lot of your credit cards as well. And it said like credit length and then credit utilization, and those numbers factor in heavily into it. And obviously, credit history and length, if you're only, graduated college last year, you're not going to have 20 years of credit history. Mm-hmm. So, keep in mind that. Credit mix is 10%. And new inquiries. That's another one we get a lot of. Is like if I go around and I'm shopping, if I shop at 5 banks, and I know you're going to talk about this later, how does that affect my credit score? So basically, like credit inquiries and new credit is 10% of your score.
So let's talk about that right now, right? Let's jump right in. So we have a hard inquiry. You are applying for an auto loan, and you are perhaps rate shopping. We know that if there are several inquiries within a window, that will be counted as potentially a single inquiry, and that will minimize the impact to your credit score. But short term, a hard inquiry can have a negative short-term dip on your credit history. On your credit score? Do you want to talk about that a little bit?
Well, there's two parts to that. There's credit inquiries and new accounts, and that makes up 10% of your score. Now, what weighs heavier in that is the number of new accounts. So if what you were mentioning, Monica, is if you're out shopping for a car and you have 4 credit inquiries within a week, they're going to know, they are being the credit bureaus, that's really in lieu of one transaction. If you're shopping for a car over 6 months, right, and every 2 months you're getting a credit, that's going to count more against you. But keep in mind, it's only 10%. What's going to affect you more is if you went out and opened a credit card and got a car and did something else within a short period of time, that new accounts has the heavier impact of that 10%. Okay. So people shouldn't, if you're legitimately out shopping for something, don't worry about how many credit apps you do. that you went to a Chevy deal, you use auto, you went to Chevy, you went to Ford, you went to a Mercedes, whatever you were going to, and they're doing credit apps, or the related banks are doing credit apps. Find your best deal is more important than worrying about your credit score.
And that window might be 14 days, 45 days, but certainly would not be 6 months, 9 months, right?
Correct. Correct.
Okay. And then you talked about.
And I think they also know, the credit bureaus know what type of loan you're shopping for by the application. So, maybe applying for a credit card and applying to General Motors for credit is going to be considered too anyway, even if it's in a short window, because they know it's not the same. Nobody's buying a car on a credit card.
You might put your down payment, part of your down payment on a credit card.
Yeah, most times they limit it to like $2,500. Yeah. Otherwise, people might be putting their thing on there to get all their points and miles. Yeah.
And you mentioned new accounts, right? If you open up a new account, especially if you have a younger credit file, the impact might be greater than if you have a more mature credit history. So you might see a dip after you open a new account, but that's just a short-term dip in some cases. And so you wouldn't, Mark, I imagine you wouldn't advise your clients, listeners, or viewers to stress if they see that short-term dip. Check back after a bit of time.
The most important part is making the payments, right? Making your payments on time counts a lot more than anything else. And, if you're spacing out your credit, right? You're getting a car now, you're opening a credit card 6 months from now, it's not going to have an effect. If you're doing everything at once, or if you do everything at once and then get delinquent, that's going to have a huge negative impact on your credit score, as opposed to those transactions individualized being over time with you having a good payment history.
So, Mark, as we talk about 3 different categories of impact, we are focused upon long-term positive impact and long-term negative impact much more than short-term dips, right? Correct. So we've already mentioned.
Correct. And the other part of that is that, I have the same rules about your credit score as a stock market. Don't watch it. Mm-hmm. Periodically check it. Every month or two you could check it, because it will have a dip. It's funny. I looked at my credit score, like I just said before, and in preparation of the show, and my credit score went down 2 points this month. And I'm like, why? Like what's happened this month? So, even though I am immune to maybe because I'm more informed than other people are, it still bothers me. Like, my credit score should have gone up 2 points, not down 2 points. Now, it doesn't really change anything, but, yeah. Seeing something go down, like your stock go down or your credit score go down, always feels negative. Yeah. But it's not something you should really pay a lot of attention to or worry about unless it's material. So
as if you take out an auto loan, you might see, due to that increased debt, a short-term dip. But if you are showing a responsible borrowing and payment history, that short-term dip will then change to a long-term positive impact. And that's why we don't need to be so focused on short-term changes. Would you agree?
So what you would typically see, and I think they're how they score everything out is very proprietary, so I can't tell you what exactly affects. But if you go take an auto loan out in August, and that might have a negative impact on your credit score, but you make the first 3 payments, I bet your credit score is higher than it was before you took the car loan out, because you took the credit and now you've shown that you can make the payments.
So let's talk right now about those potential long-term positive impacts. Let's break them down at least into 2 categories. One would be a positive payment history, which you've already alluded to, but perhaps you could add more to your comment on that. And then also an improved credit mix. Credit mix also will help have a positive impact upon your credit history. Do you want to talk about those 2 factors?
Yeah. So first of all, there's nothing more important than paying your bills on time. Even if you're not going to pay, in the sense of a revolving loan, like a car or a mortgage, that would be a fixed payment. You can't pay less than the amount each month. Even paying a credit card, the minimum balance or more still counts as being paid on time. So I would, even though we've talked before, credit card debt we hate, still make those payments. It's better to make a payment than no payment at all, okay? As far as the mix is concerned, the credit bureau, I would rate a mortgage and a car loan and a credit card completely different ways. Why? A mortgage is you're borrowing a fixed amount of money, you're paying it over a fixed amount of time. A car loan is the same thing. You're borrowing a fixed amount of money, you're paying it over over time. A credit card, especially when you have multiple credit cards, they have lines of credit on them. So credit utilization, which is what percentage of your total available credit you're using each month, has a huge impact on your credit score. That should be low. So just because you have a $30,000 line of credit, on your MasterCard or Visa, and you don't even know how you got that, but doesn't mean you spend $30,000, and if you make the minimum payments, you're fine. Using that utilization of that credit would be negative over time.
Well, let me interject this question for you. Would you agree that we have seen situations where a client might have, let's say, multiple credit cards, that they have that ability to get access to a large amount of funds and would be under the revolving credit category, and even if they are not using that can have a negative impact upon their credit score? Yes. Because they have so much, they are considered high risk because they could take on so much debt so quickly. Do you want to talk about that?
So historically, we've recommended that people keep the number of credit cards they need, and if you're going to have a credit card that you stop using for whatever reason, you got a better one, it is better to cancel that credit card than it is to have it with no transactions on it to your credit score. The other thing that, and this may affect our small business clients, it certainly affected me, was even if you have a business credit card, it is secured by your personal credit and still gets reported on your credit file. And I will tell you that it did negatively affect my credit for several years because I was using credit cards that were being paid for by the business and not paid by my personal funds, but they still were showing as revolving credit on my credit report. The solution to that is time. It didn't make my credit bad, it just it drove it down because now I have a lot of revolving credit, even though 70% of it might be related to my business.
Mm-hmm. Okay.
About the only card I think that doesn't show up as much is American Express. That's my only one because American Express doesn't have any pre-spending thing or whatever, but I mean, if you don't pay your American Express, it'll show up. Mm-hmm. And the other thing I want to talk about, because I get a lot of phone calls about this, is people call me. It's probably the most common question I get that's non-tax or accounting related about worrying about things that are affecting their credit. I get a notice from a taxing authority, from the IRS, from a local thing. Oh my God, I need they only gave me till October 5th. If I don't pay it, it's going to affect my credit. I will tell you that in my 40-year history of being an accountant, I have never seen a tax bill, talk about income tax or tax bill, show up on somebody's credit card that didn't turn into a lien. So what ends up happening is if you have a debt and you don't pay it or ignore it or it doesn't get resolved, eventually the credit bureau, the debtor can go and get a lien placed against you. And that often happens in tax situations, but it is very far down the road. And people, while we should always be respectful of the deadlines on notices that say like you owe the IRS this or you owe the state that, take that with a grain of salt. If you don't think you owe it, then there is no deadline, right? The deadline is after all your appeals are up and they don't agree with you. But if you get a notice that says you have to respond or pay by September 5th, if you don't do it till the 7th, they're not hitting your credit. And it's very important to know because that happens to be one of the things that people tend to be very hyper about. And the other thing, another reason why people are so sensitive, and we didn't talk about this yet, is that a lot of the cost of things like home insurance and car insurance does have a credit score aspect to it, not just bank loans. So having a better credit score may get you better homeowners insurance or car insurance. That's an industry where we see it a lot in.
So you're talking about notices related to tax. So let's talk about some other significant risks that do impact your credit. And I know we want to talk about late payments. We want to talk about loan defaults or repos. And you wanted, I know, Mark, specifically to talk a little bit about medical debt, you said.
Right. So again, payment history is really important. If you have a bankruptcy, if you have a credit card that gets written off, if you're late on them, you're going to have a bad credit score. There's just no way around it. And the bankruptcy is a completely separate one because that'll affect your credit score for a certain period of time. I think it's 7 years. But even if you just never went bankrupt, you just have a really bad period of doing it, it's going to take a while for you to be current, to pump that score up. And it does affect a lot of things. It could affect renting a house. It could affect, getting a car loan or any kind of loan. And the other one that I would think has the most effect historically on people's credit is medical bills. I know that they tried to take that out of the equation as much because there is a lot of medical bills out there that don't get paid. You can know from your own history, it could be because, the insurance company didn't get billed correctly, so you got to reapply it to your insurance company, or they were supposed to write it off, or a lot of times there is a game that people play. And I'm not anti this, is that you might get some medical debt and you call and make a deal, so they don't have to pay somebody who to collect. Was trying to delay the reporting time for medical debt to give people a chance to handle that in a better way. And a lot of those protections have been rolled back or limited, but that's something you should check into. But medical debt is important. And the other thing to note is you can dispute things on your credit report. So if you had a medical issue and you feel that the credit is showing up incorrectly, you can file a letter with the credit bureau explaining, and that may improve your credit score. I've had people say to me, "Well, I didn't pay my, Verizon charged me an extra $20." Hello. How are you? Do you have credit issues? If I don't pay it, it'll affect my credit score. One thing doesn't necessarily affect your credit score. You can have a dispute, and the threat of it ruining your credit is not as dramatic as the person telling you is making it. That's something to know, too. I mean, if you're defaulting on a bunch of stuff, you're going to have a credit issue. If you have a problem vendor, handle it the way you need to handle it, and don't worry about your credit score. And I'd only be concerned about my credit score if there was a material change. Like if your credit score dropped 50 points or 100 points, yeah, then you got to figure out why. But if it's just like my 2 points I mentioned before, I could feel badly about myself today because I'm down 2 points, but I don't think there's anything I really need to do.
So we want to avoid late payments, and the longer the payment is late, the more impact that late payment can have upon.
It's the length of time the payment is delinquent and the number of payments that are delinquent. They go like 30, 60, 90 days. The more it's so you have 2 payments that are less than 30 days late. That is better than having 1 payment that's 90 days late. The longer it's, the more it counts against you. How many points it is, nobody knows, but I'm just saying, the best thing is don't have anything late.
And since we're talking about credit score within the context of an auto loan, we also just want to sum up thus far your comment. We don't want to default on a loan payment, and we don't want that automobile to be repossessed, because that will likely stay on your credit report for 7 years. Yes,
would be really bad.
Okay.
The same way as every once in a while a client comes in and they have a tax form because a credit card company wrote off something.
Yeah.
And that would be reported to your credit, and there's nothing you can really do about that.
So let's talk about auto financing options, right? For today's youth, perhaps they are buying their first vehicle. Perhaps someone has purchased many vehicles. They're making some decisions. It's buy versus lease. It's buy a new car, which will depreciate in value immediately, or buy a gently used, pre-owned, perhaps certified vehicle. There are several different decisions that go into purchasing a vehicle and what makes the most financial sense for you. So let's talk about auto financing options. We have direct lending from a bank, okay, or you might go, or a credit union or another type of financial institution. And then we have dealership financing. You go into the dealership, they say, we are offering this type of promotional rate, 0% financing, and this gives you the convenience of financing your vehicle and purchasing your vehicle from you basically one-stop shopping. So we want to talk about those different options before we talk about the pros and cons of buying versus leasing.
So there's an emotional and a financial aspect to buying a car or leasing a car. I want to first deal with the emotional part, okay? The emotional part is what kind of car you may want to have and whether you can afford it or not. One of the things I really dislike still today about the auto industry is when you walk in, they don't ask you what you want. They ask you how much you can afford. Can you afford $500? Can you afford $600? And that's their way of upselling you. So I will start off first by saying, if you're buying versus leasing, you do not want a car loan that will last longer than you plan to own the car. So there are, and I saw a report just very recently, there's been a huge uptick in the number of people who are carrying 84-month car loans, which is 7 years.
Are they carrying them to term?
I'm just saying that people who have taken them out, we don't know yet, because maybe until about a few years ago, you couldn't go over 5 years.
Over 5 years. And I don't mean to derail your thought train here, but let me throw this at you as you provide your explanation to your viewers and listeners. So there is a school of thought where you might take out an auto loan for, let's say, what we would have said 5 years. That gives you maximum flexibility. If all you can afford is your monthly payment, all you pay is your monthly payment. But there is a school of thought that you don't go for 3 years or 4 years, you go for the 5 years. And then during those months where you have more discretionary income, and you can make an extra payment, you're giving yourself maximum flexibility, because if you have to just make that payment. So what is your opinion on building in that flexibility when you decide the length of the auto loan?
I would be against taking an auto loan for longer with the idea that you make extra payments. It's the same way I feel about a mortgage. You're taking it out for a certain period of time, don't prepay it. Okay? And the reason is that whether you took a 3, a 4, a 5, 6, 7 year loan would be determinant on how long you felt you would keep that car. Not, I hope to keep it 7 years, because the problem is, and this is where we're going to get into, is that in the next car you limit your options, right? If there is something to roll over, if you have a liability to roll over, it's going to be harder to lease a car. And you're going to be rolling it over into another car. So your $10,000 that you didn't pay off on car number 1 gets rolled into car number 2, and it adds to your monthly payment, and it devalues what you can afford, because that $10,000 is going to increase your monthly payment. So make sure that if you're financing a car, you're financing that car for a period of time that you will definitely keep the car. You may keep it longer, but you're not necessarily going to keep it shorter. Now, why would you keep it shorter? During COVID, I had a car, and my car was worth more than I paid for it because there was a shortage of cars. So it made a sense. It was almost like, when did you ever trade a car for more than you paid? And there may be some upside down thing like that, but that's not something you should expect. It's something that may happen. The other thing is, you mentioned like used cars versus a new car. In the auto industry, let's forget anything special, the rates on used cars are going to be higher than the rate on new cars. So that's a factor in it as well. You also mentioned about the fact that you can get financing from, say, your bank or a credit union versus financing at a dealership. So the buy versus lease thing, the first economic thing is how long you're going to keep the car. The second economic thing is which is a better deal. Are they offering, like right now, as we record this, and through the month of September, there's still a $7,500 credit available for electric cars, and almost all car dealers are factoring that $7,500 credit in leases, but not necessarily in purchases. So leasing a car, there is a concept of lease a car to own, and I've done it before where I've said, I want to keep this car, but I'm going to lease it because the leasing incentive makes a car cheaper to lease it for the first 3 years or whatever, as opposed to buying it. And when you lease,
do you want to talk a little bit about why and how, and depreciation of value? Do you want to talk about why the lease for that vehicle?
So I'll give an example. I just leased a car, and it was an electric car, and I leased it because they had all these incentives for leasing versus buying, plus a $7,500 credit. So when you lease a car, one of the reasons I like leasing a car, and this is a non-credit thing, but an emotional one, is that they sell you the car for a fixed price. There's no negotiation, right? The car is going to be $599 a month. Then when you get the paperwork from it tells you what they're selling you the car for to get the $599, and at the end of your lease term, it says what you can buy the car for. So you can factor in, think about it as a loan. Like, I'm going to buy a $50,000 car, okay? And I could finance it at X rate, or I can lease it, and after 3 years, I can buy it for $31,000. When you factor out, well, how much my payments would have been for that 3 years versus the $29,000 I'm saving off the price of the car, $19,000 I'm paying off the price of the car. So those are all different factors into that. So if there's an incentive like 0% financing or a great lease deal, that may change. You want the best deal for yourself. It's the same way when you said, should I take the loan from my credit union or get the financing from the dealership? So even if there is no incentive, it is much easier to finance a car through the banks at the dealership deals, because you do the credit app there, they can get the money, you don't have to go to a separate bank and pick up a check and bring, all the different stuff you may have to do. But it's always going to come down to what's the rate. And it's the same thing when you get to leasing versus buying. What's the cheaper option on that car I want? If you're just shopping for the best deal, that's a different story. If you're shopping for a certain kind of car, I want a Ford this or Chevy that, then you have to sort of like do your homework on which, and it gets very fuzzy, because the dealerships, even though there's much less negotiations on buying a car today than there was, used to be there. It used to be an 8-hour day.
It was a whole day.
Yeah. I got to go talk to my manager. You start walking out the door. They come back. It was very frustrating. Dealerships have become much more retail. I will give a lot of credit to Tesla on that, because Tesla was the first one that has order car online, whatever, and car dealerships now do probably a lot more internet sales than they do walk-in, especially once somebody determines what kind of car they want. Then you just put in an internet inquiry. You can do it over the phone. So it's much easier today than it was, but it's still a minefield of what payment you want to make and all these other things. And again, I get the question as a professional all the time, and it's just part of what I can do is, if you ask a professional, I always say this all the time, when you're trying to make a decision, you are subject to that decision. There's an emotional component. I really want that car. There's I look cool in that. The girls will love me. Whatever. The guys will love me. I'm sorry. I want to make sure I put that out there too. But there's an emotional thing, and then there's just being objective. And so a third party, maybe your parent or a tax professional, can help talk you through those objective things.
Right. And if the sales professional is telling you this is what it will cost you per month, you want to really drill down to
How many months?
Yeah, how many months and what is my rate? And, certainly I don't know if these days, Mark, you can answer this question. These days we don't really see any type of early payoff fees anymore like that used to be the case in years past. Would you agree that's not so much?
I have seen people that have maybe leased a car, and then they get a call from the dealership, and they're like, if there's incentives in a manufacturer to keep you in that same car. So maybe they'll forego the last 3 payments and not put them in. If you come in and lease or buy another car, you might be some of those deals. But again, back to buying and leasing. How many miles you drive is important.
Very important.
Okay, so if you drive, I will tell you, if you drive more than 15,000 miles a year, you must buy the car. It doesn't pay after that. I mean, most leases is, also be careful when you're looking online, when they say you can lease this car for $1.97. Oh, you got a visitor.
I have a visitor too.
You can lease this car for $1.97. Is that, how many miles is it? Because there's 7,500 mile lease, there's 10,000 miles lease, there's 12, and there's 15. It is cheaper to buy, if you're going to lease a car, to lease the car with the right amount of miles and say, I'm going to lease it for 10 and I'll pay for the other 2,000 at the end. It's usually a higher rate than it would have been on the monthly. Plus, it's a lump sum instead of paying an extra $20 a month. The other thing to factor into that is that people seem to think, well, if I pay off this 5-year car loan, I'll have a car worth something. If I lease the car, I have nothing. But that's a little bit of fuzzy math too, because the same car, no matter what they sell it to you for, the lease price is going to be less than the monthly payment. Why? Because let's say we're buying the car $50,000 no matter what. So you're financing $50,000 over 5 years at some interest rate. You lease the same car. What you're buying is what they anticipate the depreciation of the car to be over those 3 years.
Right, that's where I was going earlier when I asked you that question.
Over those 3 years, plus an interest factor for carrying it.
But when you purchase, it's full value of the car.
Right. So in some emotional side, paying off a mortgage and leasing a car is sort of the same thing. But I buy a car, if I put more money in my house, I own it faster, and I have something value. If I buy a car, I have something of value. But the problem with that is that you do not know what the residual value of that car is going to be. The car manufacturer is taking that responsibility, that your car will end up, and you always have the right to buy the car out of the lease. So obviously, if your car is worth more than the residual value you have to pay, then buying it out of the lease and then trading it in, or somehow doing that, may be another way to get another car without having to go.
Let's talk about that. We hadn't planned on talking about that, but let's talk about when we alert the dealership that we have a car that we want to trade in, and how the Blue Book value is going to, how the Blue Book value versus if you sell your car privately before going to a dealership versus you trade in, how those are all very different numbers. And when we talk about the emotional burden that the ease of one-stop shopping. I mean, we talked about the ease of one-stop shopping as it relates to purchasing and financing through the dealership, but making sure that we are making sound financial decisions. There's also the ease of a trade-in versus selling your vehicle privately before you go to the dealership.
Right,
can you talk about that a little bit?
One reason that it is sometimes better to trade the car in is sales tax. Mm-hmm. So if I sell a car, let's say I have a $20,000 car and my sales tax rate is 6%. Mm-hmm. Okay, if I trade it in against another car, I will be able to reduce my sales tax by $1,800, because that $50,000 car I'm now paying $30,000 for, because I'm getting $20,000 for my car. If I sold that car to you for $20,000, I get the $20,000, but then I go in and have to buy a $50,000 car. So you have to compare the net cash. And a lot of times, so there's two factors in selling a car privately. One is the actual economics, which is what's your net cash. The other is the hassle, right? You might have to go with the person to the DMV. Mm-hmm. You're taking the risk of having somebody come to your home or your office to see a car. They're going to want to take a test drive or take to the mechanic. Are they stealing? I mean, there's all kinds of stuff that maybe you feel uncomfortable. Mm-hmm. And it depends on how comfortable you are with that. So most people do trade in cars as opposed to selling them privately. But what we're also talking about is, if I was leasing a car and the lease was up, I would definitely want to know what the Blue Book value of my car is versus the residual value. If the car is underwater, meaning the value of the car is less than what the trade-in is, you just get rid of the car. And there's one other fee that's associated. A lot of cars have what's called a disposition fee, meaning you have to pay a certain fee that's $500, $750 if you turn the car in. Now again, amazingly enough, if you're going to buy the same manufacturer, even if it's a different model, there's a lot of incentives for you to re-up with them, and it makes that it may factor into making the lease cheaper or even the turnover. And as far as getting back to our original topic, which was credit scores, it does not make a difference from a credit score point of view whether it's a loan or a lease.
We've talked over many episodes about family relationships and financial impact of any type of exchange of property, goods, cash, what have you. And my question for you is, you are Mark and you have a child, and you want to you put the registration, the name of the car, you want the ownership to be in your child's name, and so you want to gift your child the vehicle. Talk about what value that will be taxed, what the taxable value is, and how you can gift your child a vehicle.
So there's a couple of interesting things here. Most states allow for sales tax-free transfer to a direct relative. So I can go in and gift my car, no matter what the financial arrangement outside is, and there's no sales tax. But from a gift tax point of view, the Blue Book value, and there'll be a range. Like if you go in and say, private trade versus trade-in versus fair, good, or poor condition, you're going to get a range, and somewhere in the middle of that would be the value, and that would be a gift, assuming you're not getting any money for your gift, and that would be part of the $18,000 a year exclusion. Now I did something very similar with my son. I had a car, and I wanted to give it to him, and he was ready to get rid of his car. So what do? We sold his car, and he gave me the proceeds of his car. I gifted him my car. Now the difference was my car was worth more than what I got, but it allowed him to get a car for Dad helped out a little bit, right? But it also saved the sales tax on the car. Now, I lost the sales tax because obviously I didn't have the car to trade in, but I leased my new car, so it wasn't as bad. I have my daughter has a 2012 car that I helped her buy. It has 140,000 miles on it. She wants to run into the ground. So there's a different, and I like getting a new car every few years. So there's different emotions there.
And if you have a classic Mustang, you do not sell it, because everyone who has regrets it. That's our tip of the day, right?
Well, I was talking to somebody this morning who said they sold their 1966 Corvette for like $100,000. He said, if I had held on to it, it'd be worth $170 now. But a lot of those people, I know those car collectors, they spend as much money on garages, and the whole idea is not to drive the car. So they treat cars more like a piece of art than it would be something that has utility. We're talking about cars here. What we're talking about is you're going to drive them every day to work, you can drive them to the supermarket, doctor's offices, stuff like that.
Good. Well, thank you for your insight. We want to thank everyone for tuning into today's episode. Let us know your thoughts below, and don't forget to like the video and subscribe to the channel, as Mark was talking about earlier in today's episode. We hope you have a good rest of your day, and we look forward to seeing you next Wednesday. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.